morning, everyone. It's my privilege this morning to introduce Dr. Ed Ireland. When a consortium of leading Barnett Shale production companies founded the Barnett Shale Energy Education Council in 2007, it selected Ed Ireland as executive director. Ireland and the BSEEC are dedicated to promoting energy education and best practices as they relate to oil and gas leasing, drilling, producing, transportation, and marketing in the Barnett Shale. Ireland's executive management experience, operational expertise, and 20-year oil and gas career made him the ideal candidate to oversee the activities of the BSEEC and implement educational and outreach programs in the 24-county area that makes up the Barnett Shale. As industry expert, he also acts as spokesperson for the Barnett Shale, as well as a community and media representative on behalf of BSEEC members. He serves on the board of directors of the TCU Energy Institute and was co-founder of the Metroplex Natural Gas Vehicle Consortium. Ireland started his career in the energy industry as an energy economist at United Gas Pipeline in Houston. He founded Energy Planning Associates and Gasmark, Inc. as a natural gas supplier and pipeline company, and later became president of GeoSource, Inc., an independent oil and gas exploration company. Ireland also served as alderman of the city of Southside Place, Texas, for 3 terms. Prior to his corporate work, Ireland served as assistant professor and head of economics department at Clemson University in South Carolina. Ireland holds a BS in economics from Midwestern State University, a PhD in economics and statistics from Texas Tech University, and did postdoctoral work at the University of Chicago. Please help me welcome Dr. Ed Ireland.
Hello. Thank you very much for that introduction. I think you know more about me than you wanted to know. I guess if I was an attorney, I would just rest my case. Got a great panel this morning, and a really good introduction there about, got a great panel this morning, and a really good introduction there about, from Pioneer, about a subject that we're going to get into here, which is the price declines and the implication that that's having currently and will have in the future on the energy situation in the United States. But first, let me just give you a good morning and greetings from the Barnett Shale in Fort Worth, our office in Fort Worth, and we claim that Fort Worth is the home of the Barnett Shale. And of course, the Barnett Shale, we also like to point out frequently, is the birthplace of the shale energy revolution in the United States and the world. And I think most of you probably know that. But let me give you one other little factoid about the Barnett Shale and the energy revolution that you may not know. And that is that when the Barnett Shale was first being developed, really by the wildcatters that took a big chance and started drilling in the Barnett Shale, they really considered the Barnett Shale to be a one-off. They didn't see that they were embarking on a shale energy revolution. They were just drilling a new field, and they really didn't think that the techniques that they were using would apply, would even work in other shales. And they certainly didn't think they would work in oil, to extract oil from shales. They thought probably natural gas, that those oil molecules were too big for that to work. Obviously that wasn't the case. And now we're seeing that we have dozens, scores of shales that are being developed in the United States and Canada and around the world. But let's turn to the subject of on the panel we're going to deal with, and that is the rapid decline that we've seen in crude oil prices and natural gas to some extent, and the drastic effect that has had on drilling, and saw that just in a graph just a few minutes ago, a drastic fall off in drilling. So the title of our panel or our discussion is "What Just Happened?" and what does that mean? What implication are we going to see about unfolding as far as the energy picture in the U.S.? And we have, we're honored to have four experts here on our panel that come from very diverse backgrounds and offer some, I think, great perspectives for you from the standpoint of oil and gas accounting, investment banking, oil and gas exploration, and private equity investments in energy projects. But before introducing them, I would like to just give one quick perspective about the Barnett Shale and what happened there last time this happened, that is price decreases. The Barnett Shale really took off like gangbusters developing in around 2002, and it was just a frenzy of activity until 2008. And in 2008, prices plummeted, oil and natural gas prices. Natural gas in beginning 2008 was approaching $14 per MCF, and by the end of the year, prices had plummeted and eventually got down to $2, even a little below $2 per MCF, so 14 to 2. Then recovered over time to $4 per MCF or so, and now I've settled back down to about $3 or a little under $3. But what happened in 2008 is interesting to look at. You had drilling activity immediately declined starting in mid-2008. But production in the Barnett Shale continued on for 4 more years. And so the drilling activity, and by the way, back in 2008, there were about 200 rigs running in the Barnett Shale at any one time. Last week in the Barnett Shale, there were 6. So that's a tremendous fall off in activity, but yet production continued to increase in the Barnett Shale until into 2012, and there it did peak and started to decline, but the decline has been pretty slow, much slower than a lot of people expected. And a lot of people will attribute that to technology, technological innovation that has made the drilling rigs much more efficient, and perfections in the hydraulic fracturing technique, where now there are horizontal drilling so that laterals are longer, there are more frac stages, and the frac fluids have been refined greatly to vary by geologic formation. So technology really has a big impact, and in the past we've seen that the technological innovations really accelerate during price declines. I heard a technology officer who was with one of the large hydraulic fracturing companies back in 2008, and he said when the price declines happened and the squeeze hit the service companies, they ramped up their innovation, their technology program. And he said very quickly they improved their technologies to the point where their costs declined and their profits actually increased. And that was all because of the pricing environment. So, you know, we could see that again. I guess that's the point here, is that technology is going to have a big impact. And by the way, I just happened to read right before we started an article saying this morning that even though drilling activity has declined so rapidly, that production in the Eagle Ford Shale is continuing to increase. And so a little bit of that pattern is repeating itself. So technology is an important factor, and maybe more so in natural gas than crude oil, and that's probably something we can talk about on this panel. So let me introduce the panelists here. We'll just introduce them one at a time and get their thoughts. And I have a few questions that I would like to ask them, but would like to get some audience participation too. So be thinking of some questions as you listen to the panelists. The first is Damon Box. Damon is a managing director in the E&P corporate finance group at Simmons & Company International. Simmons is an energy-only investment bank headquartered in Houston with offices in Aberdeen, London, and Dubai. Damon has been with Simmons for approximately 8 years and has previous experience with Halliburton, KeyBank Capital Markets, and Wachovia Securities. Damon graduated from the University of Texas at Austin with a degree in finance. Damon?
Thank you. So just to give you some background on what Simmons & Company does and the perspective that we bring to what's happened over the last 10 years or so with the unconventional resources and the environment that we find ourselves in today. At Simmons & Company, in the E&P corporate finance, our practice is largely advising buyers and sellers on E&P assets, so producing assets, acreage positions, things like that, just M&A in general. And then we also work with companies to help them raise capital to finance those acquisitions and also to finance the development of the properties after they're acquired. So our practice, Simmons has been around about 40 years. I would say the key driver of our practice over the last 10 years has been this shift to unconventional resources. And it really started with natural gas and with the Barnett Shale, around 2005, in that time frame. And then as natural gas prices really started to fall and the technology started to get better, it shifted to the oil shales 2009 or so. During that time period, there was what we have described and what some people have described over the years as a land rush, as companies that did not have existing exposure to unconventional resources really started to see the potential for it and the benefits, and that this was where the industry was headed. So it was a key driver of acquisition activity, really starting 10 years ago and up until today in the fourth quarter of last year when prices started to fall. As companies went and at first they acquired gas resources in the Barnett Shale and other resource plays, and then they shifted to the oil resources in 2009. So a big driver of transaction activity. During the same time period, they've raised tremendous amounts of capital, both in the debt markets and the equity markets, in addition to bringing in international capital in the form of joint ventures and private equity also. As investors, we're drawn to this shift to unconventional resources to really grow production and finance the transition that the industry's gone through over the last few years. For an equity investor that's looking at the unconventional resources, the appeal was really versus the historical oil and gas industry where there's a high degree of variability, people did not really have a good line of sight on inventory and on returns. Equity investors, generalists, private equity were really drawn to the fact that there was a very clear line of sight on inventory and the ability to grow and to create equity value and drill high return drilling opportunities with the equity money that was being put into it. And from an investor standpoint, there was a capability that there hadn't been in the past to really be able to project growth and profitability for these companies. For the debt investors, and debt really made up a huge portion of the financing that's happened over the last 3 or 4 years. It was a combination of the very low yield environment that we've been in and being able to kind of reach and get yields that were attractive to the investors, 6, 7, 8%, but feel that they were secured by hard assets and production, and that in general versus other opportunities in the debt markets that there was maybe less risk of default. And so there was a lot of appeal from the high yield market to finance these assets. And from a company perspective, from an issuer perspective, they were going out and they were developing and financing drilling opportunities that were delivering 30, 40% type rates of return, and they were paying for that with very cheap cost of capital, and so it was obviously all very attractive. where we are today, so the results of that was obviously first with the gas market, you had tremendous increases in gas. This unfortunately led to, as Ed was saying, a big drop in the gas prices as we've put ourselves into somewhat of an oversupplied situation. This transitioned into oil into 2009, and now after 5 years or so of oil shale development, we once again find ourselves in potentially an oversupplied situation. And if you kind of think of the peak for the oil shale development as being maybe last summer, obviously going into the third quarter, going into the fourth quarter, commodity prices really started to rapidly decline. This kind of changes the equation for one, people that are potentially looking at transactions, so you see a big drop in transaction activity, and then two, for the investors in this. So all of these debt investors that had previously come into it, they now start worrying about cash flow to pay interest payments, cash flow to start paying back debt. For the equity investors, you've seen since last summer, equity prices come down roughly 30%. They start thinking about, in a new commodity price environment, what is now the rate of return that can be generated from this portfolio of assets that the companies have put together over the last few years. So that is all a very rapid change that really just started to kick into place late third quarter, early fourth quarter last year, and we're still living it today. And so if the question is kind of what just happened and where are we right now, I think people are still trying to figure out where we are right now. The moving pieces here is if we're in an oversupplied situation, the moving pieces and one of the key questions is what happens to the U.S. oil production. And as I was saying, with the gas, even when you had a very rapid drop in the rig count, you still had growing gas production, and we still have growing gas production today, even 3 or 4 years into a low commodity price environment. And so with oil, will technology, will people really focusing on the core pieces of their basin, and will service price drops, will those things overcome the drop in rig activity to where we keep growing oil production or we keep oil production flat? And that's really, I think, the key question that companies are trying to grapple with right now, and that investors are trying to grapple with as they think about where they go from here and what is their interest in deploying more capital and making transactions and acquisitions.
Okay, thank you very much, Dean. On his right is Joe Blyce. Joe serves as the audit partner in the Dallas office of Hine & Associates, providing audit and accounting services for public and privately held companies in the energy industry. Joe has significant experience with Securities and Exchange Commission disclosure and reporting requirements, and assists companies with mergers and acquisitions, as well as initial and secondary security offerings. Joe serves as the National Energy Practice Area Leader for the firm. Prior to joining Hine in 2003, Joe served as the controller of a publicly traded oil and gas company where he assisted with a merger and a private placement for the organization. He began his career as member of the audit staff of Ernst & Young, LLP, after graduating from the University of Oklahoma. Joe?
Thank you. Is this on?
Yep.
Okay, thanks. So I am a financial statement auditor. So my comments today will be tainted by the thoughts of a person who can only live in history and who spends his days second-guessing the good work of the people that have already done the work. Come on, these are the jokes. So I thought I'd talk a little bit about some of the accounting struggles I've seen some companies go through with the effect of these lower commodity prices. And first is the dirtiest word called impairment. You know, you're all aware once commodity prices go down, if your costs don't come down, then cash flow goes down. So the fourth quarter was painful for a lot of companies because revenues went down, but costs didn't. And so where does that put you? Well, if you've got debt, a revolving line of credit, for instance, and you depend on that capital to fund your development plans, maybe because of that lower cash flow, the lower performance, maybe you're out of compliance with your debt covenants. So then how am I going to be able to use that line of credit? Second, you know, when commodity prices go down, revenues go down and costs don't go down, companies still have to put their reserves reports together, and those lower commodity prices mean lower reserves, lower reserve volumes, and lower estimated future cash flows. So same thing, if you are depending on a revolving line of credit to finance those development plans, all of a sudden the bank looks at your reserves and says, hey, you know, you used to be able to borrow $50 million under that credit facility, and you've got $30 million outstanding, but based on what we're looking at in your reserves, now you can only have $20 million outstanding. So pay me 10 tomorrow. So that hurts too. Now getting into that impact on the reserves, you know, the SEC puts out the rules and the FASB puts out the rules as to what you can call proved reserves. And part of what you have to show in order to have a proved undeveloped well is that you are substantially committed to developing that property within a 5-year period. And so if you have no access to capital and you depend on that revolving line of credit to fund those development plans, it's pretty hard to say, I am really convinced that I'm going to drill those properties as they're scheduled. So that could even drive your reserves values lower. So one of the last steps in closing a company's books is considering the carrying value of what you got on your balance sheet for an oil and gas properties. And the first step, if you're a successful efforts company, is to look at your estimated undiscounted future net cash flows. Now, fortunately, you're not relegated to using proved reserves. You can also use probables and possibles. But the first step is, am I going to make enough undiscounted cash flow in the future to recover my investment in those properties? If the answer is yes, move on. If the answer is no, then I got to figure out what are all my properties worth. So then a fair value analysis and reduce that carrying amount to fair value. Now, if you're a full cost company, you are relegated to proved reserves. So if what I was talking about earlier comes true and you can't convince your engineers and your auditors that you're substantially committed to developing those properties and you take off your PUDs, then under the full cost rules, you have to reduce the carrying amount of your oil and gas properties down to PV10. So that can result in a charge. Now I hear a lot of people say, well, that's just an impairment and it's a non-cash charge and we really run our business by EBITDAX. And I think EBITDAX is something that's really important, and I do like its use, and I think it's a great tool to be able to produce future recurring operating cash flows. But impairment and depletion, those were real dollars one day. Yeah, they were in the past. But anyway, I think they're important. So, painful things, taking impairment charges, and maybe having a little bit more difficulty accessing capital. But look on the bright side, if you've got derivatives, those are probably all in the money.
All right. Thank you, Joe. On Joe's right is Danny Campbell, who is president of Henry Resources, leading the oil and gas team. Danny joined Henry in May 2007 with 26 years of oil and gas experience and a banking background. He has a Bachelor of Science degree in petroleum engineering from Louisiana State University and is a registered professional engineer in Texas. Danny?
Thank you. I'm glad Tim had his slides this morning because it's going to make my few comments very easy. You know what just happened? Pretty simple. 5 years of $90 plus oil, drove down demand, $90 plus oil, built supply. The Henry family's been in the business for 45 plus years as an independent in the Permian Basin. And from about 2002 through about 2008, when we sold to Concho in summer of 2008, yes, we closed on July 31st and oil started dropping. But if you look at the situation during that period of time, Jim Henry and Scott Sheffield had a long discussion about the Wolfberry would have 1 to 2 billion barrels of oil recovery when we were drilling stacked verticals. And look at the slide that Tim showed today. We're talking billions of barrels that will come out of the Permian Basin, and most of that we will only recover 2 to 6% of the intervals that are being completed. And what horizontal has done, started in the Barnett with the slick water fracs, that has expanded in the Eagle Ford and Marcellus and Bakken, has now showed up in the Permian. So one of the interesting things about Permian is really still on some of the early stages of what's going on. Well, rig count is down over 50%. And so, yes, will we see a slowdown in the Permian Basin? Yes. But what's interesting is if you look at Pioneer, Concho, ELG, Diamondback, RSP, Devon, and everyone, most of those are cutting back, but they're not predicting declines, production declines in the basin. With their current cash flow and their current plans, they will be able to maintain flat production or an increase in production in 2015 and 2016. In 2007 and 8 versus 2009 and 10, I went back and did a complete look back. If you look at drilling and completion cost between the last downturn from the peak to the trough, drilling costs, just the drilling side of the well, decreased 20 to 25%. The completion side changed 40%. So we're anticipating cost structure coming down in the Permian Basin on the drilling side 20 to 25% and the completion of 40%. What's interesting is if you look at that time period and some of the past time periods, the delay in cost savings from the service companies average on about 6 months period of time. So from the time we see major drops until we see actual cost structure changes takes about 6 months or so. In this time period, we think it's going to be a year. And the reason is the last number of times this has happened in the Permian Basin, there has not been a backlog of completions. Today, there is a backlog of completions even with the rig count down as service companies cut back and they get efficiencies. Tim was right on point. What we're seeing is everyone is working very hard to get efficiencies. Guys that were working 80 to 90 hours a week, getting a lot of time and a half, are back to 40 and 50 hour a week. That's cost savings in the actual job. What we're paying for chemicals and sand and horsepower are all changing. But we don't think it's hit bottom because we're right in this. You know, if you take from November to now, we're at about 6 months. We think it's going to take the second half of 2015. So we think this downturn, because of the backlog, is going to be more of a 9 months to 12 months in service prices and everything balancing out. I'm so glad Tim's slide matches what we have calculated. We have gone through a number of calculations of all the rigs that are dropping and what we call that's been testing the outside areas, and we have a rig still testing some of the fringe areas south of the Big Lake Fault, if you're familiar with the Midland Basin. We looked and said below $50 oil, rig count continues to drop and things keep going down. Above $60 oil, because of the efficiencies that are taking place in the $60 to $70 range, you would possibly see the rig count flatten and start to increase. You would see the Pioneers, the Diamondbacks, the Conchos of the world begin to pick some rigs back up and drill some of the projects. So $50 and less, rig count we think continues to drop, prices continue to come down. Above $60 NYMEX, you will begin to see the Permian begin to level off from a rig count and a cost structure standpoint. However, even at $50 oil, we do not see a decline in Permian production during 2015 and 2016. We see this as a long downturn because of supply and demand. Now, what's a long downturn? Is that $70 oil? Is that $50 oil? We don't know. If I said it's $60 oil, the one thing we know, I would be wrong, you know. predicting oil prices and gas prices is very, very difficult, even though we use a number of models and we use Henry Gropp. Anyone that knows Jim Henry for a number of years knows that that's been a major impact. Permian's going to stay strong. It's very early, and a lot of the things that's going on, it's behind most of the other plays from a horizontal standpoint, and there is a lot of stack pay. I have some acreage I just recently picked up from a major. It will take us 2 years because we will be testing 3 major intervals, 4 major intervals. And so that's the kind of things that are still going on in the Permian, even though prices are down. In December, we shut all completions down. If it was not critical, we quit completing wells. We will start back completing wells in May, this month, with over a 35% discount, and hopefully by January of 16, we will have caught back up. We're not the only ones that did that. That's the reason we say there is a 12-month delay in service prices catching up with the activity versus last time. Permian is strong, continues to grow, but we don't think we've seen the bottom of the cost structure and the efficiencies yet.
Okay, thank you very much, Danny. And to Danny's right is Anas Alaji. Dr. Alaji is the chief economist at NGP Energy Capital Management. He leads the firm's macro analysis of the oil, natural gas, and related markets, as well as the overall economic environment. In addition to his work at NGP, he is a noted author and regular contributor to national and international publications and academic journals with more than 800 papers, articles, and columns to his credit. His articles have appeared in numerous countries in more than 10 languages, and his work is cited in over 25 books. Dr. Alaji is educated in Syria, Saudi Arabia, and the U.S. He holds an MA and PhD in economics from the University of Oklahoma with specialization in energy economics. He's received many awards, including the Teaching Excellence Award and the Outstanding Mentor Award, in addition to many prizes in woodworking contests. Dr. Alaji, what just happened?
Good morning. Since I am the last speaker and I have only a few minutes to speak, I decided to hedge against time. So whatever I intended to say and I cannot, it's written in the article that's probably, it's outside on the table. Is that correct? Yes. It's outside on the table, or you can search it on the web. It's called Living the Saudi Dream. The shale revolution reminded us of a couple of lessons that we often forget. The first lesson is never say never. Will we have $100 oil? Possible. Will we have $20 oil? Possible. So never say never. The second lesson that we be reminded is the only constant is change. But the shale revolution taught us a third lesson, that this change is happening faster and faster and faster. And the change tomorrow is faster than today. And if this idea is correct, it has tremendous implications for the industry. And probably I will disagree with some of the speakers today, because one of the implications of that speed is short cycles, not long cycles. And probably this cycle is very short relative to the previous ones. We will see. So what happened? Oil prices should have declined in 2011 with the increase in US oil production, but they did not. And they did not because of what's so-called the Arab Spring. We lost the Libyan oil, the Egyptian oil, the Tunisian oil, the Sudanese, the Yemeni, the Syrian oil, and some of Iraqi oil too at that period. So we lost that oil and prices went up. But they did not go up to 200 or 300. They barely reached 120. And the reason why, because the US and Saudi Arabia compensated for the losses between 2011 and until almost 6-7 months ago. But what happened after that is US oil production continued to go up, demand growth, global demand growth faltered, and we ended up with a situation where some of the lost oil in the Arab Spring countries start coming back. We ended up with a surplus. And we expected the Saudis to cut production to balance the market, but they did not. And we knew that they cannot do anything about it for the following reasons. The first one is the surplus was large and they cannot do it on their own. But it doesn't matter. The size does not matter. What matters here is the quality. The surplus was light, sweet crude. Most of the oil in the Gulf region, including Iraq and Saudi Arabia, is sour. And what we import from those countries is heavy crude and sour crude. What we produce from the shale revolution is light sweet. So you can see we cannot eliminate imports from the Middle East. What we did is we almost eliminated imports from countries in West Africa and North Africa because of the crude quality. So what the Saudis basically were interested in is the following. They cannot cut because if they cut, it's their own crude. But that was not the issue. What the Saudis want is to preserve market share, not only in crude, and I think this is the highlight of my presentation here, not only in crude, but in products, NGLs, and petrochemicals. Because the shale revolution did not threaten Saudi imports, US imports from Saudi Arabia. What it did threaten the strategic objectives of the Saudis and other Gulf countries when they decided to build refineries to export products, when they decided to invest in NGLs to export NGLs, and when they decided to build the largest petrochemical complexes around the world. What the shale revolution did, we exported more products, and this is in the handout. You are going to see a chart like this, where products, US exports of products increased substantially. And what we've seen basically is massive increase in NGLs exports. The growth in US exports of products did not match the global growth. Global growth, or the demand for products, was less than the rate of growth in US exports of products. What that means is we took market share from someone else. We exported more NGLs than what we expected, and the growth in NGLs exports was more than the demand growth around the world. What that means, we took market share from someone else, and that was Saudi Arabia. And then we saw the petrochemical companies coming back to the United States because of cheap, abundant gas and NGLs. Well, the Saudis are the largest exporters of petrochemicals. And they did not like that. So their behavior of not reducing production, and I just to make the comment here that the desire of the Saudis not to intervene in the market is an intervention. And then they increase production later. It's not only about crude, it is about products, NGLs, and petrochemicals. Thank you.
All right, thank you very much. In fact, Anas, let me follow up with you on a question about on the demand side. Of course, economist to economist, we supply demand, right? That's all we know. The Energy Information Administration, EIA, has for some years now been forecasting that U.S. demand for energy in general would not be growing, and specifically oil consumption declining slightly with natural gas consumption increasing. But yet recently there's been a big increase in energy demand consumption in the U.S. How do you explain that?
Well, we had a serious problem, especially in 2012, because demand for oil in the United States started declining in 2007 when gasoline was $4 and above. And then we had the financial crisis, and naturally the demand declined. But what we've seen after that, we had economic growth with decline in demand. And that needs an explanation. And there are several explanations for that. One of them is social media and the fact that Generation Y is not driving and they are still in the vans with their mothers. But what we've seen is we've seen lower gasoline prices. We've seen improvement in the economy. We've seen improvement in employment. And there is an additional issue that's been overlooked, which is we have what we call deferred demand. Whatever demand that we needed basically or should have happened during the recession and immediately after the recession did not happen because people were nervous and they did not change their car or they did not buy the other car, etc. So we have a deferred demand from the recession and its aftermath, and it led to a major increase in demand in the United States. Just to give you an idea how large it is, the growth in demand for gasoline right now is the highest since the early 70s. So the idea that those efficiency programs are going to reduce demand in the United States, well, they are going to lower the growth a little bit, but they are not going to lower demand itself.
Selling a lot more F-150 trucks now to burn that gasoline. I think Danny and a couple of you mentioned about the frac log, I guess we call it, the backlog of wells that have been drilled but not completed. And at the same time, I mean, and that's a significant overhang. I think that, in other words, you've got a lot of crude oil and natural gas ready to hit the market almost at a moment's notice. Just what do you think? When will that happen, do you think, say, in the Permian Basin, and what impact would that have on the area?
Yeah, in the Permian Basin right now, with the rig count down, a lot of the service companies have tried to increase their efficiencies by, we've actually lost one frac company and number of frac crews, or the frac crews are now splitting time, so they're still getting 40 to 50 hours instead of 80 to 90 hours. And so even with the rig count down, the completions are still moving forward or coming back on. And so we think it's going to take the whole second half of 2015 to work that backlog off. We know that ourselves and other companies are beginning to put things back in the frac schedule. So we think in 2008 to 2009, most of that backlog did not exist as rigs dropped fairly quickly. And the frac companies caught up pretty quick. This time, we think it's 6 months longer. So we think all of the second half of 2015, there are wells being fracked that were drilled in December or January or February that normally would have been completed by now.
So you don't see any decline in production from the Permian Basin?
We see no decline in the Permian Basin in 2015 and 2016 with the current rig count and the current backlog of production, completions.
Okay. Not too long ago, I was in Midland and hadn't planned to spend the night, but ended up spending the night and started looking for a room and could barely find one. I finally found a Quality Inn for $400 a night. I know there's been a lot of construction activity in the whole Midland, Odessa area. Do you see that continuing, or
no? We already see a change. 2 years ago, if you wanted a room in Midland, Texas, $300 to $400 was very common. Most of the service companies and most of the folks had most of those floors leased out because they were bringing crews in from all over the country. Today, we have already seen a significant change. If you come to town, getting a room at $100-something, probably half of what you paid 2 years ago is very available. And with all the apartment complexes that have been built and the new hotels, we think by the end of 2015, you will see it back to a normal $100-something a night in the nicer hotels in Midland, and you'll probably get some bargains in some of the other ones.
What about the high-rise office building that was on the...
It's not going to take place. We knew that oil was on a decline when they announced of a 45-story building in downtown Midland. Most of us in Midland knew that meant the boom was over. And it was confirmed. It did not carry through. That is probably going to end up being a hotel, and I think it's 20 floors or 18 floors or something. It's going to be a normal building with a hotel right in the center of downtown to try to help revive downtown. But the 45-story building did not materialize with their plans. But the joke around Midland, for many of you that have been through the cycle since the late 70s, early 80s, we knew the boom had come to an end again when they announced that building.
Okay, all right. We've mentioned service companies here a number of times and the pressure that's on service companies to reduce their cost for hydraulic fracturing and other completion services. I saw one projection not too long ago that by the end of the year or in not too many months, there's going to start being a tremendous consolidation of service companies, mergers and acquisitions, the bigger companies eating the smaller companies. And of course, that typically happens to E&P companies in a downturn as well. So Damon or Joe, what do you think might be happening in the M&A world here?
Okay, I'll take that one. The M&A world for E&P companies, and I think today for service, although it's a little bit outside of my area, has been very quiet since we started seeing the commodity downturn in the third quarter of last year. One of the worst things for the E&P acquisition market is volatility in commodity prices. If you have prices that are relatively stable, there's consensus on what direction they're going, it's easier to get buyers and sellers together as far as valuations for properties go. Obviously, stability is not what we've had since the third quarter of last year. And so just to put in perspective, the A&D market, the acquisition divestiture market for E&P properties over the last 3 years on average has been $17, $18 billion a quarter for the U.S. of announced transactions. First quarter of this year was $1 billion. So to go from a run rate of $16, $17 billion to $1 billion, it might as well just be none. And it's completely just thrown ice on the market. I think the direction we're going throughout the year is this will obviously change. Transaction activity will start to come in. And there's two things I think will generally drive that. Is one, when you start getting a consensus on prices back together. We just saw a fairly large Permian acquisition announced this week. It's the first one that we've seen really since the bottom fell out. And it was at valuations that were pretty close to what you were seeing last summer. And I think that's just reflective of how good the Midland Basin is versus other plays in the country and how strong those economics are that people are willing to pay those kind of values even at these commodity prices. So you'll start to see some of that come back into it. But the second thing that you'll start to see is that for companies that just over-levered and really had a capital structure that was set up for a higher price environment, eventually, unless commodity prices really recover, that will start to wear down on them and hedges will start to roll off. And they'll get to the point that they have to do something. There'll either be distressed selling or there may even be mergers between companies to help cut costs and get efficiencies. It's been too early. We haven't seen that yet, but it may come.
Joe, you mentioned impairment charges and with the decline in the value of reserves. What is that becoming a problem for a number of companies, or how do you think that can unfold here in the near term?
Well, I'm going to answer that in two ways. And it really vastly depends on your accounting method. So for instance, full cost companies, the impairment test on that is just PV10 of the reserves at SEC prices. So SEC prices is the unweighted arithmetic average of the first day of the month price in the 12-month period preceding the date of the reserves report. So for instance, at 12/31/2014, for oil, that was still around $95. As we roll those reserve reports forward from quarter to quarter, and those higher prices from the beginning part of 2014 roll off, the reserve values will go lower. Full cost companies will probably take another impairment charge every single quarter until the price starts to rebound. So full cost companies may have avoided an impairment charge at 12/31/2014, but you'll probably see several of them booking some every single quarter. Now, successful efforts company, we talked about earlier that you're not relegated to just proved reserves. You can also consider the effects of probable and possible reserves. And so I don't know what the statistics are, but I have seen a great deal of companies with the successful efforts method still avoid an impairment, because if you add in the carrying value of the unproved properties to your proved properties, and then you start comparing that to the undiscounted cash flow of all your reserves on a 3P basis, there still looks like there's plenty of cash flow to recover the investment. But I'd watch that, because as time goes on and companies have either slowed down their development plans or canceled the development plans indefinitely, then the likelihood of those probable and possible reserves has to decrease logically. And so the risk factors that they apply to those reserves in estimating what the future cash flows might be would logically increase, and therefore the value of the properties could go down.
Okay, great. We have a few minutes left. Are there any questions from the audience? Yes.
And I also wonder, could you share some of your keen insight into the natural gas market with respect to the transformation in the Gulf Coast and the...
Okay.
The question was, natural gas used to go to the Northeast. Now there's a chance of coming back to the Gulf Coast, being exported, or going into into Mexico's. Did I state that close enough?
Yeah. Yeah. Thank you.
I'm going to rephrase the question in differently, if you don't mind. In a sense, with all the changes we are seeing, do we have enough market for all the increase in production that we are seeing? Am I correct? Okay. If you look at the balances in the next few years, for example, we are expecting the Marcellus to add another 12 BCF a day within 3 to 4 years. So we will see from the Marcellus and the Utica probably 3 BCF a day. If you look at the takeaway capacity from the Northeast and the planned pipelines, we do have enough takeaway capacity, especially with the start of the LNG exports in the United States. So if you look at the total increase based on our modeling, basically we expect the total in the United States to increase by 20 BCF a day. And if you look at demand, demand could exceed 20 BCF a day. Exports to Mexico already increased, and they are expected to continue to increase. Exports to Canada, to Eastern Canada, are expected to continue to increase. The industrial demand for natural gas is expected to increase. The power demand, we got to see what's going to happen, because this is going to depend on the new EPA regulations. And the big dispute among experts right now on how much LNG we are going to export. We are seeing numbers from 4 BCF a day to 16 BCF a day. And by 2020, will we see 4 to 5, or we see 7 to 8 like the DOE is expecting, or 12 like the industry is expecting? And I think that's what's going to drive prices in the future.
In fact, if I could ask you a follow-up question on that. And a lot of the news reports talking about OPEC say that Saudi Arabia is, cash-wise, they can handle these low prices, but some of the other OPEC members cannot. That is really putting a strain on some other countries. How do you think that will play out in OPEC?
OPEC members, including Saudi Arabia, they need prices above $80 to keep peace in the street. They do, no matter what. They need, yes, their budget is flexible. The mega projects and the spending on mega projects is flexible. Governments can change the date of the completion of those projects, but they cannot influence people's need. These are not flexible. So there will be a day when they are going to be forced, basically, to do something. We already have seen problems in Venezuela, for example. We already have seen problems in in Iraq, so the impact is bigger. I just would like to make a comment on U.S. oil production. From a modeling point of view, or from market balances point of view, U.S. production already declined. And the reason why, because the forecast at the end of 2014 was that the U.S. will add 1.2 million barrels a day in 2015. And now people are talking about only 300 to 400. So we already lost 600,000 to 700,000 already from market balances point of view. And here's the evidence. In the last 3 months alone, the Saudis increased production by 800,000 barrels a day, and prices continue to go up. That means there was a room in the market. So even if we see an actual increase in U.S. production, it's actually a decline because the forecast was to add 1.2 million.
Okay, great. Thank you very much. Were there any other questions from the audience? Take one more. Okay, well, thank you very much, and I'd like to give our panelists a round of applause. I think they did a great job.